The market doesn't know what keeps you up at night. It doesn't know when you want to retire, and it doesn't know how old you are. The simple truth is, the market doesn't care. But if you care, you've tuned into the right place. You're listening to Investor Resources, bringing clarity to the confusing world of finance. Here are your hosts of Investor Resources, Don Creech and Perry Sykes.
I'm Don Creech.
And I'm Perry Sykes, and welcome to the Investor Resources Podcast.
One of the most popular investing books is by Jeremy Siegel. I don't remember when he first published it, but it's been out a couple of decades. I'm pretty certain of that.
It's a long time. Yep, been out there a long time.
And he's a professor, so he's academic, does research, and the book is considered almost biblical for its presentation of being a buy and hold long-term investor. And in our radio show and our seminars and now our webinars, we frequently refer to long-term is longer than you have. And now there's
Correct.
been an update to the work that Jeremy Siegel did by another professor, Edward McQuarrie. He basically set the book straight because he did a deep data dive into financial records and found some really interesting stuff that says if you're a buy and hold investor, you're a long-term. It means really long-term, and it doesn't mean that you've managed to mitigate risk just because you'd use modern portfolio theory and decide to add some bonds. That's not
Absolutely
reality.
True. Yep, it's really not. And a couple of the things he did was really broaden out and look at specifically a number of different countries. It's not just U.S. centric. He also looked at a much broader bond market and came out with some return numbers that are just startling. They were to me anyway. Just looking at what can happen and the mantra, Don, like you said, buy for the long run. You're basically going to be safe. You're going to be okay no matter what. And this new data is showing that in most of the world, 20 years or even 50 years sometimes will not get you a positive return on a stock. And
Well,
we're more
wait a
internationally.
minute. Think about that.
Yeah.
20
Yeah.
years of investing and the return is still negative. And in some countries, after 50 years of buying and holding the market, you still have a negative return. That's
Correct.
not the fundamental assumption that investors are making when they put money in stocks.
No, you're figuring, well, if I give it a decade, there's virtually zero chance I'll have a negative return. That's kind of a commonly held belief, and it's just not true. There are plenty of countries, United Kingdom, South Africa, Portugal, France, Spain, Japan, where they've got 50-year periods, and the total return is less than 3%. For 50 years, Italy, you can find negative returns over a 50-year period. And if you go back to one of those little short time frames, like 20 years, just 2 decades, there's a laundry list of countries that have had negative returns over 20 years, not the U.S. market. And Siegel focused mostly on that. But if you're in Germany or Belgium or Portugal or France or Spain, Japan, Italy, Norway, Sweden, they all have negative return periods with 20-year returns in there. So it's much, much easier to find those long-term drags on your portfolio than you think, especially if you're just looking at the United States. And especially these days with the amount of data and the ease with which you can invest in international markets, virtually no one is exclusively just U.S. investors. So we're investing in those other countries, and from our point of view, there's even a bigger reason to be watching trends, watching momentum, tracking the money, and to see, well, are things going well right now or not? Because if they're not, it can be bad for a long, long time, way longer than you're going to be alive.
So it begs the question, what's the difference between the work that Jeremy Siegel did and that Ed McQuarrie did? And one of which is the expanded database that's available today that probably was not readily available when Dr. Siegel did his initial work. And he's updated
Would have
his
been
book.
much harder. Yeah.
But it still has limitations. This new work includes 5 times more stocks So that includes globally a lot more stocks and a lot more
Correct.
international. And it
Yep.
includes somewhere between 5 and 10 times more bonds. When Dr. Siegel did his initial work, in order to figure out what bond returns, he would pick a bond for each time period, not a collection of bonds, not a diversified portfolio. And he
Right.
didn't really know what bond prices were. He had to assume what they were mathematically by looking at the yield at the time. So he was making assumptions about how things should have been. And now with more data available, we have a better idea. So this expanded coverage also captures more failures. One of the problems in Dr. Siegel's work is called hindsight bias, or excuse me, survivorship bias.
There you go.
Things things that didn't make it to the end of the exam period get dropped out of here. Only the only thing that does get counted is the stuff that's has enough financial resource to survive the real difficulties that were in the market. And so we look at banks, for instance. Banks have had significant periods of failures. Just think of the 30s here in the United States.
Right.
But if
Got a little rough.
but if you go overseas, bank failures are almost a way of life. You change the
Yep.
government under a dictator and banks fail. And it's just the way things kind of work. And then
Very
you think
common.
of technology changes, and we don't think of this as technology, but at the time it really was. We had canals that were replaced by railroads, right? Why do you need to ship on a raft down the Erie Canal when you've got a railroad? The Erie, Pennsylvania Railroad is running alongside.
Correct.
It's faster, it's easier, it becomes cheaper. I mean, uh, railroads then fell on hard times, and actually, railroads, for the most part, were never dividend payers. And now we have airlines that replace railroads for some shipping. Railroads can't go overseas. You got anyway. All of those things are major changes that change investors' attitude, and people don't readily accept the transition and or even recognize it until it's pretty well developed. On the bond side, I think you mentioned this, bonds are actually at least as volatile as stocks, and in many periods
Correct.
are actually more volatile than stocks. And yet,
Happens
bonds
often.
today, investors are told you put bonds in your portfolio because they're the safety factor. And we're now working on the third consecutive year of the US AGG. That's I think it's Goldman's aggregate bond index. Third year of year-end losses, and we aren't at year-end here yet, but so far year to date, the total return there remains negative.
Correct.
That's your safety valve. That doesn't seem to be consistent with the theory of investing a diversified portfolio. And your comment was that's why we pay attention to trend.
Yep.
Where's the money going? Where are investors putting their money? Because that's what's going to drive price.
It's very
Whether they're
easy. It's very comfortable to sit back and tell yourself, you know what, I'm a diversified investor, and I'm in for the long run. I don't have to worry about that this is doing poorly right now. It'll turn around, and it will. The problem is that time frame can be so huge. If you're already in retirement, if you're already 65 or 70 years old, you're not looking at 50 years that you have to wait for things to be okay. And hopefully you're looking at longer than 20. But that's too long a time period to sit back and say, well, I'm going to let time be my safety factor, because that's what you're saying. You're saying, well, I'm just going to, if I wait long enough, this is going to be okay. And all of this new data that's coming out is verifying the fact that we've been talking about, that things can stay really bad way too long, or even if it's not really bad, even if it's just flat. You can't have zero return in your portfolio for 20 years and be okay in retirement. That's not part of your plan. It's not part of anyone's plan. Growth is always built in. And if you can verify that, hey, there are long, long decades where you're going to get no return or negative return, you need to take action. You need to do something about that. And you can. You just have to be willing to say, I'm not going to sit still and let that market roll over me. And that's what a lot of firms are going to tell you, because that keeps your money invested with them. We're just going to leave it here. We're going to leave it alone. And that's the prudent thing to do, they'll say. It's just that that doesn't happen to be true over very, very long periods of time.
So when you think about long-term investing, it's actually appropriate for pension plans, insurance companies.
There you
They have
go.
long, they have long-term liabilities. I mean, Social Security should be invested for the long term because its payout liability is nearly a century. I think they calculate 75 years, but they have a long-term payout period. That's what investing for the long term actually means. But when you think about that, the the per year return between 61 and 2000, that'd be 1961 and 2011 is a 50-year period of time, and you have a return of negative almost 24%. That's not, unfortunately, that's not compounded, but, but
Right.
you've
Right.
been here for 50 years and your account's 25% lower than when you started. Or if you take 20-year periods of time, which is more suitable for individuals to plan on, because they can
Sure.
think of that one. Unfortunately, you don't have all your investment pool available when you start investing. You start investing with a small amount and you have to build it up over
Build
time.
it up.
So
Sure. Yeah.
so when we look at these rates of return on periods, we really need to adjust the fact that we don't have our money available for the entire period. That's
It's a good point.
that's one of the problems with using historic rates of return to pick an investment, because it assumes you have all your money available at the beginning of that review period, and it's virtually never the case. But the worst average return in this study over 20 years is, as you said, is minus 3%. Uh, or worst cases, you're looking at a minus 47%. Uh,
Ouch.
20 years later, not counting for inflation, your account is virtually half of what you started with. That requires paying attention to your account. As we say frequently when we close our webinars, is this isn't an activity for slouchers, but somebody has to pay attention to what's going on and be ready to make adjustments when conditions change. Running your portfolio really isn't any different than you would do if you were a pilot or you had your own boat and you were going fishing. The winds and the tide move you off course. In the world of investing, economic policy, fiscal policy, elections, profitability of major industries, international relationships move your portfolio off course. Somebody has to look at that, and you can do it if you just take the time and have some tools and discipline to pay attention, systematically review, and not be afraid to say, that was a bad decision. I got to get out of this one.
That's it. And we're not saying that stocks are a bad investment over the long term. They're a very good investment. It's a very good place to have your money. It's a bad place to just let your money sit and not pay attention to it, because there's a lot more risk than people are led to believe, even over long time frames. And it's far from a sure thing that you're going to have a gain built in when you do that, when you leave it sitting for a long period of time. So you need to be on top of it. We just, especially these days, markets change so fast and so much that you can't just set it and forget it and walk away. You need to be on top of it all the time, and you need to, like you said, Don, you need to be prepared to make a change when necessary, and not say, well, this did really well for 5 years, so I'm just going to keep it forever. Doesn't work anymore. You've got to move on. You've got to cut losses when things begin to go south, and don't hang on to it, because it can stay negative for a very, very long time.
So we've seen from this updated data that even the worst case scenario, stocks in most countries had small positive returns after 50 years, but that's longer than most people are going to invest. You
Sure.
simply don't have enough time to accumulate the money, and then you need to spend it typically when you get into retirement. But just because the equity investments have a slightly positive return in nominal terms doesn't mean they can't be a great investment. So whether or not stocks for the long term is a good decision depends upon your entry, when you accumulated, and when you needed distribution. All of those ultimately are timing decisions, some of which you can control and some of which you can't. I mean, you
Correct.
can't always control when you have money available to invest. You can't always control when you find you have to tap your resources and spend it on unexpected large items that disrupt your plan. One
Which are
more
going to
reason
happen.
they are going to happen.
They're
One
going to
more
happen.
reason
Yeah.
why somebody needs to pay attention. You want our opinion about what you're doing and what you hold? Give us a call, send us an email. We'll be glad to do an analysis the way we look at markets and particularly your particular investments. We don't need to know how much you have invested. All we need to know is what you have invested, because that determines whether or not it has approval by the majority of investors who are pushing prices higher, or maybe you own something where the majority of present investors have decided to leave the game and you're facing a potentially significant drawdown on your asset. Subscribe to our podcast, go to our website, iriradio.com, and register for the next webinar. Have a great day.